Welcome to our complete guide on Canadian tax residency. Understanding the rules of tax residency in Canada is essential, especially if you're planning to move here, spend significant time, or even manage tax obligations globally. Canadian tax laws define your residency status based on several factors that will determine your tax obligations, both in Canada and abroad. In this video, we will dive deep into everything you need to know about tax residency in Canada, from establishing your status to understanding your tax responsibilities and the advantages of becoming a Canadian taxpayer. The first step in determining your tax residency in Canada is understanding the criteria set by the Canada Revenue Agency, or CRA. Unlike other countries with simple day counting systems, Canada adopts a holistic approach to residency. The primary method employed by the CRA is the Residential Ties Test, which examines your connections to Canada compared to your ties in other countries. This test analyzes various aspects of your life in Canada, including where you live, work, and maintain your social and economic life, providing a comprehensive look at your residency status. Another important factor is the 183-day rule, which highlights physical presence in Canada. Although Canada doesn't rely solely on day counting, spending 183 days or more in Canada during a calendar year typically classifies you as a tax resident for that year. It's important to note that these days do not need to be consecutive. Rather, they're cumulative throughout the tax year. This threshold is crucial not only for establishing residency, but also for determining eligibility for a Canadian tax residency certificate, which can affect various tax obligations and benefits. Canada recognizes different types of tax residents, including full-year residents, who maintain their ties throughout the year and are taxed on their worldwide income. Then there are part-year residents, who establish or sever ties within the tax year and are subject to varying tax implications. Additionally, some individuals may be deemed residents for tax purposes due to specific conditions, even if they do not meet the traditional residency criteria. Understanding these classifications is essential, as they impact the way residents are taxed in Canada. Navigating the tax implications of being a Canadian resident is crucial. Residents are taxed on their worldwide income, which encompasses all income sources beyond just Canadian earnings. Furthermore, Canada has a progressive tax system with rates that vary based on income levels and locations. Tax credits, deductions, and foreign tax credits also play a key role in minimizing tax burdens. Understanding these elements can help streamline your financial planning and ensure compliance with Canadian tax laws.